Hello, my name's Tim Gregory. I'm from Vermeer Investment Management in the UK, and I want to start today by wishing everybody well, and that I hope that they're getting through this rather extraordinary and difficult time that's been caused by the COVID-19 pandemic. Today, I want to focus on central bank policy and why it's had such a big impact on the stock market and other asset prices in recent weeks. What we know is that back in March, when the markets were cascading downwards, the Fed stepped in very aggressively to stabilise markets by targeting the buying of bonds in a way that perhaps they didn't do in 2008-9 when we had a financial dislocation. But this time, learning the lessons from 2008-9, the Fed stepped in very aggressively to stabilise markets. And this has really worked and has pushed stocks back up towards levels that we saw around the beginning of the year, which feels quite extraordinary given the dislocation that we have seen in economies. But this has been a deliberate policy to inflate asset prices and keep markets stable by the Fed and by the central bank in tandem with government policy that's also attempting to stabilise the economic environment as well. And recently, we saw a small sell-off in markets, a fall of about 7%, including a day where markets came down 6% in one day alone. And it was quite clear that quite soon after that, the Fed were determined to step in and suggest that they were going to start buying individual company bonds as a way to once again stabilise markets and make it clear to investors that they stood ready to do absolutely whatever it takes to continue to stabilise markets. Now, that's been very good for the market, but it's also had the effect of pushing valuations up to very high levels, particularly for a number of companies in the growth area of the market whose franchises are seen as particularly stable. And it's also rallied those parts of the market that were in particularly difficult areas like airlines, civil aerospace and the auto industry. So it's had a very good effect on the whole market. And of course, what we don't know at the moment is actually what the trajectory of earnings are going forward for years, not just 2020, but 2021 and 2022. And this, I think, is obscuring the picture somewhat. But in the meantime, what we do know is that valuations for growth companies have been pushed to ever higher levels, and those that in some ways are unrecognisable historically. But investors are very keen to focus on those franchises that have got great stability, a strong moat, and they are less concerned, it would appear, about valuations. And perhaps the last time we saw this, and where we might draw a comparison, was in 1999. And obviously what followed from that was the bursting of the tech bubble in March 2000. Now, it's too early to say that we're going to be in a position where we're going to see the bubble burst, and it would appear that Fed policy is absolutely determined to continue to stabilise markets and keep asset prices high. And for the time being, we see this as the key narrative for the market, and we don't expect policy to change, and therefore we don't at this stage expect markets to divert their course, and so we expect a continued period of stability going forward. Hope everyone is well. Thanks very much for your time today, and I look forward to speaking to you again soon. Thank you very much.